Investors who own bond ETFs like BND, AGG, TLT, and others often make mistakes when filing their state tax return. Depending upon how much interest you receive, how much dividend income that you receive off your bond ETFs, and the state that you live in, these mistakes could potentially cost you thousands of dollars in extra taxes that you are unnecessarily paying. The problem with your state tax return is this. You receive a 1099 from the custodian where your bond ETFs are held. That 1099 is going to show how much in total dividend you received from your various bond ETFs. But what it will not show is the percentage of the dividend that was from U.S. government securities. So in order to properly file your state tax return, assuming you live in a state that has an income tax, you will need to go to the bond ETF provider's website and research what is the percentage of the ETF's dividend that came from U.S. government securities, and then make a manual adjustment to the income that you receive from that ETF or various ETFs, bond ETFs, when you file your state tax return. If you or your CPA, and as I've said in other videos, many CPAs miss this. If you don't do this manual research and adjustment, you will incorrectly file your state tax return and potentially cost yourself thousands of dollars in extra and unnecessary taxes. I'm going to show you how to do this research for two of the most popular bond ETFs, AGG and TLT. Then we're going to take a look at an example for AGG. If you have an iShares ETF like AGG, TLT, or others, you want to go to iShares Tax Library, look under the Tax Documents section, and then scroll down until you find this file right here. 2024 U.S. Government Source Income Information. Lots of documents here, right? Confusing. Click on this document. Here's what you're going to see. This is going to be the tax information that will show you the percentage of the ETF's dividend that came from U.S. government obligations. Front and center, we see AGG, U.S. Aggregate Bond ETF, 36.94%. So what that means is that almost 37% of the dividend from AGG is going to be state tax exempt. Unless you make a manual adjustment to your state tax return, adjusting the dividend down by 37%, you will end up overpaying in taxes on your AGG dividend. If you simply take the dividend that was reported for AGG on your 1099 and enter that on your state tax return, you just made a mistake. So you need to make this manual adjustment. Let's take a look at TLT. TLT is going to be down here at the bottom of the list. Here we are, iShares 20+ year Treasury Bond ETF, 99.19%. Almost all of TLT's dividend is going to come from U.S. government securities. That means it's state tax exempt almost entirely. Here again, if you aren't manually adjusting your state tax return to account for the fact that most of the dividend from TLT is state tax exempt, you're going to be paying taxes on the whole dividend when you shouldn't be. If you had received $50,000 of dividends from AGG in 2024, we multiply the total dividend by the percentage that was from U.S. government securities, 36.94%. That means that $18,470 would be state tax exempt. The remaining amount would be taxable at the state level. Don't make the mistake that many people make and pay tax on the entire dividend. Make sure that you make this manual adjustment when you do your state tax return so you don't overpay on taxes. For many investors who use asset allocation portfolios, you probably have a lot of U.S. government securities income in your portfolio and you don't even know it. Unless you conduct this research on every one of your fixed income ETFs or asset allocation funds, you're going to be overpaying taxes at the state level. If you have questions about your investments, please give my office a call. We would be happy to give you a free second opinion on your portfolio. If you like this content, please share it with your friends. I hope this video was helpful. I hope it gets you thinking, helps you better analyze your investments, and overall improve your family's financial plan.